Hi everyone! In this video I want to show you exactly how much taxes I saved in 2024 with my rental properties and how the German tax system works in practice when you invest in real estate. My name is Hans, I invest in residential real estate here in Germany and I currently own 15 rental properties with a portfolio value of around 3 million euro. On this channel I share very practical real-world insights into how real estate investing in Germany actually works based on my own experience and real numbers. Before we look at my personal numbers, let's briefly explain how taxes work in general when you own rental property here in Germany. When you rent out a property, your rental income is taxable, right? However, the tax system doesn't only look at income. It also allows you to deduct most expenses that are directly related to generating that income. This includes mortgage interest, maintenance and repair costs, property management fees, insurance, travel expenses related to the property, professional services, and depreciation, among others. Depreciation is especially important. It allows you to deduct a portion of the building's value every year over a long period of time. The key point is that depreciation is a non-cash expense. You don't actually pay that money every year, right? It's simply an accounting mechanism that recognizes the gradual wear and tear of the building. However, from a tax perspective, it reduces your taxable income just like a real expense would. Because of these deductions, many rental properties generate what is called a taxable loss on paper, even if the property is financially stable in reality. That taxable loss reduces your overall taxable income and therefore lowers your income tax. As you know, Germany uses a progressive tax system. This means that higher portions of your income are taxed at higher rates. Once you exceed roughly 67,000 euro of taxable income, every additional euro is taxed at around 42%. That is what we call the marginal tax rate, right? Therefore, if you're a high income earner, every euro you deduct above that threshold saves you roughly 42 cents in taxes. This is one of the key reasons why real estate is particularly attractive for high income earners here in Germany. It allows you to reduce your taxable income in a structured and legal way while building long-term assets at the same time. Now, let's look at my numbers for 2024. In 2024, my employment income was roughly 81,500 euro. In addition to that, I had approximately 14,500 euro of other income. If you add those together, my total taxable income before considering rental properties was around 96,000 euro. I know that many of you out there watching my videos also have a similar income range, so you can take that as a reference. Now, here comes the crucial part. In 2024, my rental properties generated a taxable loss of 56,400 euro. Really high. That means that from my taxable income of around 96,000 euro, 56,400 euro were deducted. After subtracting the rental losses, my remaining taxable income was roughly only 39,600 euro. Instead of being taxed on 96,000 euro, I was effectively taxed on around 39,600 euro only. That is a reduction of more than half of my taxable base. Now let's go deeper into how this negative 56,400 euro came together. The first major driver was depreciation. Several of my properties were depreciated using different rates. Some used the standard linear depreciation of around 2%. However, other properties also used a so-called Restnutzungsdauergutachten, which is a certified evaluation of the remaining useful lifetime of that building. If that remaining useful lifetime is shorter than the standard assumption, the 2%, you are allowed to use a higher annual depreciation rate. In some of my units, depreciation rates were above 8% even per year instead of the usual 2%. That significantly increases annual depreciation and therefore significantly reduces taxable income. If you want to dive deeper into the topic of Restnutzungsdauergutachten or evaluation lifetime reports, I once made a video about that and you can watch it here. The second major driver was interest. Since all of my properties are financed, the interest portion of the loan is fully deductible, right? In the early years of a loan, the interest portion is relatively high, especially with higher leverage. That means that you get strong deductions in the first years while the tenant is paying the rent. The third major driver was renovation and maintenance. In 2024, several properties underwent renovations. There were balcony renovations, window replacements, heating maintenance, bathroom renovations, and various smaller works. As long as these qualify as maintenance and not as capital improvements, they are fully deductible in the year they occur. Now, it's extremely important to understand the difference between taxable loss and cash flow. Cash flow is calculated as rent minus interest minus non-allocable costs minus the repayment of the loan. Depreciation doesn't affect cash flow because it's not a real cash expense. A property can therefore be cash flow neutral or only slightly negative while still generating a significant taxable loss. And this is where many beginners get confused, right? They see a taxable loss and assume that the property is financially bad. In reality, they might be building equity through loan repayment while reducing the tax burden at the same time. Now let's look at the bigger picture. Without rental properties, I would have been taxed on roughly 96,000 euro. Because of my rental portfolio, my taxable income dropped to around 39,600 euro. That means more than 56,000 euro were effectively shielded from taxation. At a marginal tax rate of around 42%, that reduction translates into substantial tax savings. Now you might ask whether this is realistic for beginners. It's important to be honest here, right? A taxable loss of 56,400 euro doesn't come from one small apartment, of course. This is the result of me buying multiple properties, leverage, strategic depreciation, and renovation-heavy years. However, it's absolutely realistic for a beginner with 1 or 2 properties to generate several thousand euro of taxable loss per year, especially if the property is financed and includes depreciation. The key is understanding the mechanics and structuring your investments properly from the beginning. Before I close this video, I also want to mention that I'm hosting a full-day online workshop on the 18th of April, where I teach the fundamentals of real estate investing in Germany step by step. In that workshop, we go through finding properties, analyzing deals, financing structures, and avoiding common beginner mistakes in much more detail. If you're interested, you can sign up on my website at germanrealty.org/events. Now, in summary, in 2024, my rental properties reduced my taxable income from around 96,000 euro to roughly 39,600 euro. That is a reduction of more than 56,000 euro overall. This is not theory, right? It's how the German tax system works when you invest strategically into real estate. Real estate in Germany is not only about appreciation and cash flow, it's also about understanding the tax framework and using it intelligently to build long-term wealth. Thank you for watching. I'll see you in the next video. Take care.